Hey everyone, welcome to today's Explainer. We're jumping straight into a totally fascinating market environment right now, one that's basically defined by an epic, high-stakes tug of war. On one side, we've got these incredibly heavy macroeconomic forces pulling the whole system down, what we're going to call macrogravity. But on the other side, we're seeing these explosive microeconomic successes just rocketing upward, giving us microvelocity. So let's break down exactly what happens when these two forces collide.
To really wrap our heads around this, we need to juxtapose two staggering extremes. On one hand, you have this crushing, almost incomprehensible weight, a 40 trillion national debt threshold. And directly contrasting that, you have a completely gravity-defying event, a historic 177% single-day stock surge for a single biotech company. Understanding exactly how these two wild realities coexist is our main goal today.
Okay, let's start with that heavy macrogravity, $40 trillion. That is the U.S. gross national debt. It's a threshold that's honestly hard to even visualize, but functionally, it now completely dwarfs the entire annual output of the United States economy. And, this isn't some overnight phenomenon. It's the compounding result of decades of structural spending across Medicare, Social Security, and various stimulus programs. This right here is the massive weight pulling down on the systemic level.
So how do you manage a weight like that? Well, the U.S. Treasury has effectively stepped in as the bond trader-in-chief. They are actively intervening in the markets, announcing they're doubling their 10, 20, and 30-year debt repurchases and committing to at least $4 billion plus per operation. The goal here is pretty clear, to artificially suppress those long-term borrowing costs. And, for a moment, it's working as symptom relief. We saw 30-year yields actually drop to 5.19% and the 10 slip to 4.65%. But analysts are warning that this is really just treating the symptom, not the root cause of running 6% deficits when we're at full employment.
Now, as you might expect, this $40 trillion reality is creating a massive fracture over at the Federal Reserve. On one side, you have the hawkish dissenters, folks like Lori Logan and Neil Kashkari, arguing that, hey, we're in the sixth year of elevated inflation, our current policy isn't restrictive enough, and we need small rate hikes right now to prevent painful shocks later. Contrasted sharply against that is the patient view. They're pointing to the August data where core CPI fell to 2.5%, which is the lowest we've seen since March 2021. And right now, the market is definitely listening to the patient side. The probability of a September rate hike literally plummeted from 51% down to just 34%.
So what are traders actually doing to navigate this volatile mix of massive debt and Fed uncertainty? They're turning to a strategy called the bear steepener. Let's walk through it. Step 1. Traders buy 2-year treasuries, basically locking in short-term safety. Step 2. They simultaneously sell 10-year treasuries, effectively betting against the long end of the curve. And the outcome? They profit as investors eventually demand a higher term premium. Basically, they want a higher reward for taking on the risk of holding long-term debt, amid all those rampant supply concerns we were just talking about.
Now, the crucial bridge between those macro fears and our micro hopes is what we call the productivity buffer. According to Boston Fed data, inflationary pressures are absolutely pushing up. We're seeing a 1.9% increase from wage growth and a 1.4% increase from tariffs. But massive tech and AI-driven productivity gains are acting like a giant shock absorber. This productivity buffer is bringing inflation down by 0.9%. Think about that. Technology is successfully offsetting nearly a full percentage point of the inflationary blow, netting inflation out at 2.4%. Innovation is quite literally fighting inflation on the ground.
Which perfectly transitions us to the micro side. Let's see how this innovation builds incredible escape velocity. We noted this at the start, but we really need to appreciate the scale here. Moderna experienced a generational 177% single-day gain. And no, this wasn't just random market froth. This was driven by a massive clinical catalyst. They had a wildly successful phase 3 trial, combining their experimental mRNA vaccine with Merck's Keytruda for high-risk melanoma. It literally cut cancer recurrence or death in half over 5 years. To put that into perspective, it's only the second S&P 500 stock in 25 years to gain over 100% in a single day. But to truly understand a spike like that, we have to look at their strategic evolution. See, the market isn't just pricing in a single successful melanoma drug. It's pricing in the complete scientific validation of an entire platform. Step 1 was the infectious emergency with their COVID-19 vaccine. Step 2 was core expansion into respiratory and flu portfolios. But Step 3, personalized oncology, proves that this mRNA technology can be highly targeted. Analysts are now projecting they'll be marketing 7 or more products across respiratory, oncology, and rare diseases by 2027. Now that is microvelocity in action. And we're seeing similar, explosive,
Highly structured microvelocity over in the tech and AI sector too. Alphabet, Google's parent company, is in an absolute arms race to break their dependency on NVIDIA's hardware. So they're executing this brilliant $12 billion supply chain warrant with Marvel. And the structure of this deal is highly strategic. Step 1 gives an immediate upfront vest of 1.3 million shares, but steps 2 and 3, those are dynamic. They only unlock in tranches as Marvel actually hits $500 million product revenue milestones. It's a massive, multi-billion-dollar bet on custom AI silicon, structured specifically to guarantee results.
But hey, unchecked velocities always meets friction eventually, right? And here is the 2027 risk that tech world is currently staring down: the AI capital crunch. While surface-level venture capital looks fantastic, California VC just hit a record $366 billion, the underlying gauges are flashing some pretty serious warning signs. Funding quality is deteriorating rapidly as hyperscalers abandon cash reserves to use complex debt vehicles instead. Simultaneously, economic strain and physical infrastructure limits are forcing these tech giants to cobble together highly expensive, off-grid power systems just to keep their data centers running.
Which brings us to a really fascinating dynamic, the buyback paradox. On one side, you have an absolute masterclass in counter-cyclical value creation by South Korea's SK Hynix. They're deploying cash for a massive buyback right after selling shares at a 50% premium. They successfully sold high and are buying lower, all while their stock is up 470% year over year. Contrast that with the warning from U.S. historicals, which often show pro-cyclical value destruction. Historically, the S&P 500 sets records for stock buybacks at exact market peaks, like the 2000 dot-com bubble or the 2007 financial crisis, but then they completely stop buying when stocks are actually cheap.
We are also seeing intense friction over in the crypto markets regarding the Clarity Act. Right now, the legislation is completely deadlocked. On one side, there's a strong push from the White House and the industry itself. You've got Trump urging passage to stay ahead of China, and government agencies actively courting industry executives. But pulling entirely in the opposite direction is deep congressional gridlock. Democrats are stalling over ethics concerns regarding personal crypto investments, while the GOP is hesitant due to fears from community bankers that local deposits might flee to crypto accounts. Okay, let's pull all of this together. It's essentially a matrix of crosscurrents. On a systemic, macro level, we are navigating the severe headwinds of that $40 trillion debt, while being pushed by the tailwinds of AI productivity and massive Treasury interventions. Meanwhile, down on the idiosyncratic micro level, you have explosive breakthroughs from companies like Moderna actively fighting against deteriorating AI funding quality and retail consumer selectivity. This is the exact map of the opposing forces that investors are trying to navigate right now. Looking ahead, we really need to know what's coming next. So here are the critical waypoints for your calendar. Tomorrow, we get a double feature: macro data with weekly jobless claims, plus micro earnings from a major consumer bellwether, Walmart. Then, on September 9th, we watch policy in real time as the U.S. Treasury officially implements those expanded $4 billion-plus long bond buyback operations. Will the intervention hold? And finally, mid-September brings legislation to the forefront with a key Senate vote on that deadlocked Crypto Clarity Act. Expect continued volatility across all these dates.
Which leaves us with this final, crucial question to chew on. As $40 trillion in heavy macro gravity constantly wrestles with this explosive microvelocity from tech and biotech, what ultimately wins out? Will historic government intervention actually be enough to stabilize the traditional system, or will this unchecked, rapid-fire innovation simply break away and chart its own path entirely? It is arguably the defining financial question of our moment. Thank you so much for walking through this explainer with me today. Keep this framework in your back pocket as you watch the markets this week.